Hi, good morning. This is the introduction video for the partnership accounts, chapter 17. Okay, so what we're going to learn in this chapter. So the learning objective, okay, we're going to see what a partnership is, how the profit are shared, whether with an agreement or no partnership agreement. Okay, and then how to prepare the partnership accounts. So the partnership accounts involve capital accounts, current accounts, appropriation accounts. Okay, and then we're going to see the financial statement for partnership. We do have income statement as well as statement of financial position. And lastly, we're going to see the advantages and disadvantages of partnership. Okay, basically, what is a partnership? So a partnership is a form of business that involves two or more people with an intention to make profit. Okay, so it must be two person at least or more people. How many maximum depends on what type of partnership they are formed. Okay, so this person are called partners. Alright, there's no written agreement is required, but partnership agreement is recommended. Okay, so it's suggested lah to prepare a partnership agreement. So in UK, based on your syllabus, partnership business are governed by the Partnership Act 1890 in the absence of formal partnership agreement. Meaning to say, if there's no partnership agreement is prepared, so the business are governed by this Partnership Act. Okay, for certain regulation lah, right? Okay, so in the partnership agreement, or is also called as a partnership deed, it is drawn up to avoid misunderstanding and confusion among partners in the future, especially when profit have to be distributed. Therefore, it is a document meant to resolve any dispute or conflict that may arise. So it's very important actually to have this partnership agreement. So inside a partnership agreement, basically this is the item that they will include in. Okay, we have the capital to be contributed by each partner. So they will decide who contribute more, who contribute less. Okay, the ratio which profit and loss are to be shared. Okay, so basically maybe the ratio will be more for those that contribute more, right? So it will be fair. Amount of drawing allowed. Okay, they must have a maximum amount of drawing that the partner can withdraw from the partnership. And what is the interest on capital? Is there any? How many percent? Interest on drawing? Is there any? How many percent? Salary agreement. Okay, maybe the partner works for the partnership, so they may agree certain salary payment lah, and any procedures to be followed on any partnership changes. So this partnership changes is actually will be discussed in detail in chapter 18. It may include the admission of new partner, retirement of old partner, and also dissolution of the partnership itself. Okay, let's say there's no partnership agreement. So this is the important part where let's say you don't have partnership agreement and the business are being protected by the Partnership Act. So this one's fixed. So you have to memorize this. Basically, it's very simple. It says that all partners are entitled to contribute equally. Okay. No interest is payable on capital contribution. No interest is charged on partners drawing. Not entitled to salaries. So you see here all are no, and the contribution for the capital are equally. So because of this, the share, profit and losses are equally. Okay. The partners are entitled to 5% on loan given to the partnership. So these two, so highlight these two. Okay. These two parts are very important. Okay. If there is no partnership agreement. Okay, for the partnership accounts, we start with the income statement and appropriation accounts. So this income statement is basically similar to what we did in the sole trader. Okay, it's just take note that it will include the interest on loan to partners in an expenses. So after you get the net profit from the income statement, which is the last part, we have to extend the income statement and prepare the appropriation accounts. So this appropriation begin with the net profit, right, from the income statement, and then you have to include all revenue and expenses related to partner. So what is the revenue and expenses related to partner? We can see it will be a double entry from current accounts. So this is the current accounts columnar form, right? So it will be interest on capital, salary, share of profit, interest on drawing, share of losses. So profit and losses is either one. So the one that I put in star here is not come from appropriation. Interest on loan come from income statement. Drawing come from the question. Okay. So basically when we see here, right, there's involved two parties, partners and partnership. Partners is a person, partnership is a business. Okay. So if let's say interest on capital, partnership has to pay to partner. So it become an expenses to partnership. Similar to salary, partnership has to pay to partner. So it become expenses to partnership. So in the current accounts is credit. So in appropriation is debit because it's expenses to partnership. Right? Okay, the other one, interest on drawing. So because a partner withdraw the money from the partnership, the partner have to pay to the partnership. So it become revenue to partnership. Right? Revenue is credit. So credit in appropriation. Credit appropriation, debit current accounts. Okay, we're going to see in detail in this part, but you have to understand the double entry related to this appropriation and current accounts. Okay, and next we have capital accounts. So this current accounts and capital account will be prepared in columnar form to show each partner column. Okay, so capital account shows capital introduced by partner, capital withdraw by partner, and also any item appear during partnership changes. For example, is there any goodwill, profit or loss from revaluation of asset and on realization. So this one is the partnership changes that we'll discuss in detail in chapter 18. Okay, the important things that we need to highlight here in the partnership is, right, interest on drawing normally being calculated according to monthly basis, unless stated otherwise. If they didn't mention when the drawing is took place, let's say they just give you straight away the annual drawing, so no need lah, we calculate annual interest. Okay. Interest on loan from partner is not an appropriation account. It's not an appropriation of the profit. It will be debited in the income statement as an expenses, but not in the appropriation accounts. So by now you must know the difference between income statement and appropriation. Alright, so it's like an extension from your normal income statement. You have to prepare appropriation accounts just to record whatever revenue and expenses belong to the partners. Okay. If there is no partnership agreement, Partnership Act will be applied. Like I mentioned previously, you have to memorize those items that related to Partnership Act if there is no partnership agreement. Okay. If partner do not maintain current accounts, let's say they don't open up current accounts, all item in the current account, which is all appropriation, will be recorded in the capital accounts. So they have only one account, which is capital accounts, but combined together. Current and capital are combined together. Okay. We'll go through the advantages and disadvantages. So advantages, with the partnership, you will have more capital because the capital will be combined by two or more partners. Sharing of knowledge, experience and expertise may offer a greater service to customer. Share of workload, okay, maybe one partner cannot do this part, so the other partner can cover. Losses are shared, right? The disadvantage, lack of freedom to act individually. So you have to ask for another person or another partner opinion, so you cannot do your own decision. Disagreement may occur, so the dispute. Profit have to be shared by all partners. Instead of you take all the profit alone, you have to share the profit with all the partners. And partner may be legally liable for the acts of the other partner, right?